This poker chip represents 1 share of a stock, and these 100 poker chips represent 100 shares of that same stock. Suppose you really like this stock and you want to hold it for the long term, so you buy them. Okay, great. You could be done here, and a lot of people don't do anything more than this. But you could also capitalize on these 100 shares by selling a call option or writing a whole new call option and selling that for cold hard cash. When somebody buys this call option from you, that money is now yours, and you can do whatever you want with that. But now one of two things can happen, and in this video we're going to cover the two possibilities that can take place after this. So to try to make this easier to understand, let's think about what it means when you buy an option contract. When you buy an option contract, you have the right to buy lots of 100 shares at a future date, but at whatever price the strike is that you're buying. So on the flip side of that, when you're selling an option contract, what happens is somebody else has the right to buy your 100 shares at whatever price is the strike that you're selling. So if you bought the shares at $50 a share, but you're selling a $55 call, then that means that if it passes $55, that person can exercise the contract and they'll buy them from you at $55. Or if it doesn't, you just collect a premium, you walk away with it, you made a little bit of extra money on your shares, and then afterwards you can do it again and continue doing this with your existing shares. So while that explains how this works fundamentally, let's go into an example and we'll show exactly step by step how everything would turn out in both cases. Okay, so to start off our example, we're going to use Lucid. It's trading at just under $42 right now, but let's say you bought the shares at $40 and you got 100 shares. That's going to be your collateral to build your covered call position. And let's say you sell a call. Maybe you sell a $45 call and you collect $395 for a call that's 2 weeks out. So you spent $4,000, you made $395. Now, one of two things is going to happen here. Either it's going to go up and it'll pass 45, in which case you'll make 500 more for selling it at 45 and also collecting the 395, so you'll make 895, or it stays the same or goes down or whatever, it just doesn't reach 45. Maybe it stays at 4,000 flat, and now you just made $395 out of nothing. You collected the money, and you can either think of this as profit or you can think of this as lowering your cost basis. Maybe instead of thinking of it as profit, now you can imagine that you got the shares for $3,605. For the example, we're going to show the outcome of it going up to 45 and you getting exercised on first. So first we'll draw a little graph here, and this is Lucid, it's going up, and let's say right around here it's at 40, which is where you bought it, and then we'll put another line here. This is where your $45 call is that you sold, and let's say it keeps going up. It's making its way up and it hits the 45, and when it hits the 45, you bought them at 4,000, then it went up to 45, so you made 500, you collected your premium of 395, but you had to sell your shares because you got exercised on, but you don't really care because you just made $895. That's the first outcome. On the other hand, let's say it didn't go up and you sold this call, you collected your $395, and then maybe it went down a little bit and it closed out at 37. And so you just lost $300 from it going down to 37, but you collected $395 from the premium. So overall, you still ended up at a profit of $95, and you still have your 100 shares. So now after that one expired, you can sell another one and collect another $300 or another $395 or another $200, depending on what strike and what date you want to set it at. So as you can see, whether it goes up, stays the same, or goes down a little bit, in all three outcomes you make a profit. If it goes down a lot more, maybe it goes down to 35 or 34 and you lose $500 or $600, obviously at that point you'll be losing more, but that's not as likely, and even if that does happen, you're supposed to be doing this on companies that you believe in the long term anyway. So then at least that way you can be collecting premiums, lowering your cost basis, and you're still holding the shares of the company that you believe will go up in the future. And so at the end of things, you're making money on it either way, basically, whether it goes up or stays the same. The only downside is that if it does go up and let's say it passes 45 and it runs all the way to 49, you still will have to sell it at the 45 and you'll miss out on that additional $400 of potential gains. But again, you're going to be collecting the $395 from the premium anyway, so it would have to really run far for that to outweigh how much you'd be getting from the premium. And so it just would make more sense to do it that way. And I'd rather lose on potential gains than lose my actual money. You just have to make sure that you're comfortable selling at whatever strike price you're going to be selling your contracts in. If it's a company that you really don't want to let the shares go because you just really want to hold on to them, if you're going to be selling calls, you should probably be selling them really far out of the money and a little bit closer to the date, so that way it's not as likely that you will be exercised on and that you'll be assigned. So how do you decide what strike price and what expiration you're going to choose to be selling your call options on? That really depends on how much you want to hold the shares and how much you don't really want to let them go, and also how much premium you want to be collecting for them. But we'll go back into another example and show a few different outcomes of different strike prices and different expiration dates you could choose and how likely those are to be assigned on you or not. So here are a few different examples of different strikes that you could be selling calls on with your Lucid shares, and these are for 2 weeks out. It's currently trading at just about 42, so if you were to choose a really, really close out of the money strike, it's probably pretty likely that it's going to pass 43 and you may get assigned. And because it's more risky, you're going to collect a lot more premium, and the person's going to have to pay a lot more money to you to have that ability to buy them at a cheaper price. So you would collect 445 at the 43 call, and 420, and then 395 like I showed in the example before for the $45 call. And then just to show you like another example, at a $60 call 2 weeks out is pretty unlikely that it's going to run 50% more in only 2 weeks. So for that one, you'd only be collecting 172. So this is kind of up to you at this point. If you were just trying to generate as much profit out of it as possible in the short term right now and just get a lot of premium, maybe you'll stick with the $45 calls because it's only a $50 difference and it's a $2 difference in the strike. So, it's more likely that you'll be able to keep on repeating that process. But if you really kind of want to hold the shares and you just wanted to experiment with this, but you don't really want to let the shares go, you would sell a further out of the money strike, like a $60 strike. And at least even then, if you did get exercised on, you would make a lot. You would make $2,000 between the 40 and the 60 plus your 172. Or you would just continue doing that. And maybe after 2 weeks, that $40 runs up to 47, but you sold a $60 call. Now, maybe at the end of that 2 weeks, you decide to sell a $70 call or a $65 call so that you're always staying far out of the money and just continuing to collect a little bit of premium at a time, lowering your cost basis over the long term and keeping your shares. Okay, so now I'm going to show you an example of how to do this within the Robinhood app, just because I know a lot of the people that are in my trading group use Robinhood. So we're going to also use Lucid for the same example. So first thing you're going to do is go onto the app. You're going to go over to search for the company, Lucid, and the first thing you're going to have to do is buy 100 shares of the company, of the stock. Then you're going to go back, press trade options, and just to say consistent with my other examples, I'm going to go out to November 19th, 2 weeks out, and I'm going to go to the $45 call. You can see right here it's trading at about $3.95, just under that. You're going to click on that one, your $45 call or whatever call you end up wanting to sell. Press sell, review, and then you would swipe up and close that option. And once you have sold that option, you don't need to buy that option back. It'll either expire worthless or it'll go up and you'll be assigned, but it'll be fine because again, you're going to be selling it at a higher price than where you bought it, a higher price than your cost basis, and you'll also be collecting the premium. So all in all, that's really why covered calls just as a whole are like the cheat code. Like really, no matter which way it goes, you're gonna make money. It's really hard to lose with them, and there's just a lot of consistent rewards with them. So thanks for watching. I hope that helped you guys understand how covered calls work and how to trade them. Also, before I finish up the video, I just wanted to say if you guys ever need any other help with trading or getting started with these kinds of strategies, you can always join our Discord group. The link is down in the description below, and we're in there every day. We're in there talking strategy, helping each other with everything. And if you ever want to go in there and get started with covered calls and need just a little bit of guidance when you're starting up, join, let us know, and we'll walk you through it step by step. Thank you for watching.